Hello everyone. Today's topic is R2R questions and answers. This is part 2. I have also made part 1. Please check out my video. So let's get started. First question is, what is debtor reconciliation? Debtor reconciliation is just like a BRS, bank reconciliation statement. So the definition is, it is a reconciliation of balances between branch to branch transactions. Example we take, suppose in our books of accounts balance sheet there is a person named called Ravi. Under his name rupees 5,000 is appearing in my balance sheet. Okay, let's assume that he has directly deposited his 5,000 rupees in my bank account, that is SBI account. So my books of accounts and bank accounts will not tally. Okay, so there is a difference of 5,000 rupees. So this is an error. For this purpose only we maintain the debtors reconciliation. Next question is, what is bad debts and provision for bad debts? Bad debts, we know that the amount which is irrecoverable or not recoverable or collected from the customer. Okay, in that case the entry will be bad debts account debit to customers. Like we have just studied the example of Ravi. Suppose we are not able to recover or he is not able to repay the 5,000 rupees, then that customer will become suppose he become insolvent, then in that case will the entry will be bad debts account debit to customer's account with the amount of rupees 5,000. Clear? Now provision for bad debts. Provision for bad debts means estimated value of bad debts. Suppose if we make a provision for the bad debts at 10% provision we have made for the bad debts. So 10% of this 5,000 is 500 rupees. So the entry for this will be bad debts account debit to provision for bad debts. Okay, so the amount will be 5,000 into 10 by 100. That is the 10%. So the amount is 500. Alright. Next question is, what is the entry for credit purchase? It's quite very simple. Purchases account debit to creditors account. Alright. If the question is like, what is the entry for cash purchases? Then that in that case you know very well the entry will be purchase account debit to cash account. Next question is, for what purpose we are exactly using the reversal journal entry? Reversal journal entry. Reversal journal entry is generally used to clear out all the prepaid and accrual entries from the prior period. Here prior period means the previous period we are talking about. Alright. So that the transactions in the current period can be recorded normally. See, if we don't reverse the journal entry, then the business may or may not be show the true financial position of the business. For that purpose, reversing the journal entry is very necessary. Next question is, what are the golden rules of accounting? We know that there are 3 golden rules of accounting. First one is personal, second is real, third is nominal. The rule for the personal account is debit the receiver and credit the giver. Real account, debit what comes in, credit what goes out. Nominal account, debit the expenses and credit the incomes. Next question is, what is the difference between cash account and cash book? See, cash account is an account in the ledger, whereas cash book is a separate book. You know that we are maintaining so many accounts under ledger. We maintain ledger, under ledger we maintain so many accounts like furniture, building, okay, then sundry creditors account, sundry debtors account, cash account, bank account. All these accounts we prepare under one book, that is ledger. Okay, now cash book is a separate book. Cash book is a separate book just like an ledger. But when we prepare cash book, we don't prepare cash account, because already in the cash book we are maintaining the cash and bank balances. Next question is, what are the adjustment entries and why they passed? These entries are passed at the end of each accounting period to adjust the nominal and other accounts. To adjust the nominal and other accounts so that the correct net profit or net loss is indicated in the P&L and balance sheet. See, it is very necessary, essential to pass these entries before preparing the final books of accounts. If we don't pass these entries, then the P&L statement will be misleading and they will not show the true financial position of the business. Next is amount received from the sale of goods comes under capital receipts or revenue receipts. It is important. See, sale of goods comes under revenue received. Sometime interviewer asks that instead of sale of goods, he can ask you sale of fixed asset, okay, sale of furniture or building. Will it come under revenue receipt or capital receipt? In that case, you need to answer that all the fixed asset, if the sale of fixed asset, furniture, building, land, plant, machinery, it will come under capital receipts, not in revenue receipts. Okay, so money obtained from the sale of goods comes under revenue receipts, not in capital receipts. Next question is, why is closing stock valued at lower of cost or realizable value? It is based on the principle of prudence or conservatism, according to which all anticipated losses should be taken into account, but all unrealized gains should be ignored. See, we have seen the example of bad debts. It says, according to this principle, it says that all anticipated losses should be taken. We are taking the bad debts into our account. We are seeing that we all anticipated losses, we are taking that, yeah, this is going to be happen, this taken. But gains we cannot take into account until unless we actually received that amount. All right, that is why the closing stock is valued at lower of cost or realizable value, because this principle of prudence or conservative, this principle plays very safely, and for the true financial picture of the business we have to play it safe. Next question is, what adjustment is made of outstanding expenses while preparing the final accounts? Let me know that on the one hand, under P&L account, we are showing the trading expense on the debit side. Outstanding expenses on the debit side of the P&L account, and under balance sheet we are showing the outstanding expenses under liabilities head. Under liabilities there is one more head, that is current liabilities. So under current liabilities, outstanding expenses come. Next question is, bill of exchange is drawn by the debtor. Is it correct? No. Bill of exchange is always drawn by the creditor and it is accepted by the debtor. Who is creditor? The creditor person who sells the goods. Who sells the goods. So he is known as, either you can say seller, creditor, okay, and in bill of exchange terms we call it as a drawer. So the bill of exchange is always drawn by the drawer. All right, so this is just to make you confused that it is drawn by the debtor or the creditor. So bill of exchange is always drawn by the seller, creditor, or drawn not by the debtor. Debtor only receives the bill of exchange.